The payback method for assessing capital investments has a number of drawbacks that we'll review, but it is still used commonly because it is easy to understand and in most cases, pretty easy to calculate. So it's in regular use and it's good for you to know for lots of reasons. Let me cover some tips and reminders before we work some problems here. The first is conceptual questions about the payback method are likely to focus on the negatives and the positives of the approach. We'll review those here in a minute. Please remember that what is used for calculating payback is after-tax cash flows. It's not pre-tax cash flows. It's not some accounting net income type number. It's after-tax cash flows. Just keep that in mind and you'll be fine. Remember that the calculation of payback differs if the cash flows are expected to arise evenly versus unevenly over the course of or the life of the project. If the cash flows are even, well, then it's pretty easy, right? Even cash flows, payback is a fairly simple calculation. It's the investment, sort of the cash outflow at time zero, divided by those after-tax cash flows. And you can see the acronym I've built there. But as long as those are the same, well, then that's your answer, and it's fairly straightforward. I'm going to work one of those, but I'm not going to spend a lot of time on it because it really is that easy. And once you've got that equation in your mind, you'll be fine for the exam. No, the more difficult payback problems are those where the cash flows are not the same year over year and you have to calculate it with a little bit more difficulty, but it's still not that bad. The other thing we'll review here is discounted payback, right? I can take those cash flows over the life of the project and discount them into today's dollars and calculate a discounted payback method, which overcomes at least one of the disadvantages of the payback method, which is that it ignores the time value of money. It doesn't have to. We can calculate payback using discounted cash flows and get a metric that does, in fact, incorporate the time value of money there. And then just watch out for partial years, right? In many cases, the payback method, the cash flows will actually reach zero, not cleanly at the end of one year or at the end of the other, but somewhere in between. And we're going to have to calculate where that is, what proportion of the year will have passed when we actually hit the payback point. And calculating that is not difficult, but we will review it, and I want you to be aware of that. So let's work some problems here to make sure we're in good shape. Okay, here are a couple of conceptual questions, as I mentioned, about the advantages and disadvantages of the payback method. First one says, despite its shortcomings, the traditional payback period continues to be a popular method to evaluate investments because in part it, what? Well, A says, provides some insight into the risk associated with a project. That is true and is the answer, actually. But let's move on and talk about why the others are not right before coming back to A. B says, ignores the time value of money. Well, that is true. It does ignore the time value of money. But that is a shortcoming, right? It's not something that makes the payback method popular despite its shortcoming. That is a legitimate shortcoming, and so that's not the answer. It focuses on income rather than cash flow. That is not the answer because it's simply not true.